Hey everyone, welcome back for chapter 4, gross income exclusions and deductions for AGI. And we will look probably in Form 1040 also. We did that already, so not a big deal. The learning objectives are here on your screen. We are going to look at some gross income that can be excluded, recognize various fringe benefits, and describe deductions for AGI, and that it's in the Form 1040, and look at some Roth IRA and traditional IRA, and some tax deductions and exclusions for education-related expenses, and also look at the Form 1040. So let's keep going. There are a lot of things to look. Life insurance proceeds. Usually, life insurance proceeds paid because of the insured's death are tax-free. Why? Because you pay with after-tax money to buy a life insurance, right? You paid for it with after-tax. You get the proceeds, it's tax-free. That's something that you did yourself for your family, let's say. Gifts. The recipient of gifts or inheritance excludes from gross income the value of the gift or inherited property. The donor of gifted property may be subject to gift tax. Okay? However, the recipient is not taxed on these transfers. After the transfer, any subsequent income the property earns is taxed to the recipient under the normal tax. So gifts are not taxable to receiver. We have sometimes tax-exempt interest. Interest received on general obligation bonds of state, territory, or District of Columbia is not taxable. That means if you buy municipality bonds, let's say, state bonds, those interest will not be taxable because federal government wants to provide some more chance for those type of small governments to raise capital by issuing bonds and providing non-taxable interest to investors. Educational saving bonds, Series E and I, you can look at those by reading here, but let me find something. So we have some eligible institutions that they are, either private or governmental institutions. If you pay any of the tuitions to those qualified educational organizations, those expenses includes tuition fees paid on eligible institutions. Those are qualified expenses. If you use the savings bonds income to pay for those qualifying education expenses, it will be tax-free. To qualify for exclusions, the taxpayer must be registered owner of the bond. Married taxpayer must file returns to qualify for exclusions. Bond issued to persons under age 24 do not qualify for the exclusions unless they receive the bonds upon death of the, let's say, parent. Okay, so let's see, keep going. Taxpayers use the following formula to determine the interest exclusion for applying the phase-out rule. So initial exclusion equals to interest portion of the proceeds that you receive from these bonds, multiply with the ratio. The ratio is qualifying education expense out of the redemption proceeds, but the qualifying education expense, you have to deduct non-taxable education benefits minus expense used in computing education credit. So those expenses that you use for American Opportunity Credit, you cannot double dip it in here. Make sense? So you have to take them out.
What is the qualified education expenses minus what is non-taxable education?
Qualified education expense is, it was the on page before that, it says like tuition, books, those are qualifying education expense. However, if you use those expenses or a portion of it for American Opportunity Credit, you have to take that out so you don't double dip. Let's say your education expense is $10,000. Out of $10,000, you use $4,000 to apply for American Opportunity Credit, right? So 10,000 minus 4, how much is left? 6,000. Make sense? That 6,000 is the qualifying education expense divided by redemption proceeds. And multiply that ratio, multiply with the interest, that is initial exclusion for the interest out of those bonds. Double E bonds and I bonds. After you got your initial exclusion, there is one more calculation to do, which again, your software will do it for you. It's based on your modified AGI minus a threshold that you cannot exceed. If your income exceeds that threshold, your initial exclusion will be all the way down to 0. So it's mostly helping those moderate income taxpayers, but not helping those rich taxpayers. So here is an example for it. If we do that, it might help. Fred and Ida Smith file a joint return. They claim their daughter, Inez, as a dependent. During the year, the Smiths paid $5,000 for Inez's tuition at Kennett State University, where Inez is full-time student. During the year, Inez received $1,000 non-taxable scholarship. Okay, so far so good. In September, the Smiths redeemed $10,000 of Series EE bonds. Of the cash received, $1,500 is interest and $8,500 is principal. So they took $10,000 out of that bond, they redeemed it, $1,500 was interest. Principal, $8,500 is good. That's your principal. There's no issue over there. But we are our focus is on this $1,500 interest that they redeemed. The Smiths modified AGI is $133,950, consisting of $132,450 of salary and $1,500 interest that we were calculating the exclusion for. So add them up, it's $133. But the salary was $132. Qualifying education expense for the year was $4,000. Why? Because $5,000 education expense minus $1,000 non-taxable scholarship, that left only $4,000. Because the Smiths did not use the entire $10,000 of proceeds on qualifying education expenses, a portion of that $1,500 of interest income does not qualify for exclusion. So they want to give you an exclusion only up to limit that you spend on your education. You cannot say, oh, because my daughter goes to college, I want to exclude the whole $1,500. They said, how much of that, how much did you dedicate to the education expenses? The entire $10,000 is not paid for education. Only $4,000 was paid, technically. Okay, the initial exclusion is $600, which is $1,500. The interest exclusion, which is here, interest portion, $1,500, multiplied by 4,000 out of 10,000. So 4,000 out of 10,000, that gives you 40% ratio that you dedicated to the education. 40% ratio multiplied by $1,500 interest that you got out of that redemption, that gives you initial $600 of exclusion from income. So far, so good, but it's not over yet. Since the Smith modified AGI exceed 128,650 of modified modifying jointly threshold, they must further reduce and calculate the amount of the exclusion. The amount of reduction is $106, which is 600 initial exclusion multiplied by a ratio. The ratio is how much modified AGI is above the threshold, which is, let's say, $5,000 something. 5,000 out of $30,000, that gives you a ratio, whatever it is, multiplied by $600, that much will be excluded. So only $494 of that $1,500 interest that they earned from that redemption of the bond, that will be excluded. The rest will be in the income, and they have to pay taxes for that interest that they earned. Make sense? So IRS wants to make sure that how much you spend for your education, and based on that expense gives you a ratio that you multiply with the interest earned to get interest tax-free amount. And there's a form that normally the software will fill it up for you. Form 8850. So here is the calculation for modified AGI and having some other information, non-taxable scholarship, total expense 5,000 minus scholarship is 4,000, proceeds from the bond is 10,000, and interest that earned is $1,500. Okay, so then the form will be filled up by your software. Exclusion of interest from Series EE and I U.S. saving bonds issued after 1989. And these numbers will be filled up in the form, and that final number, 494, will be tax-free interest, and that tax-free interest goes into Form 1040 in line 2A, tax exempt interest. 494 goes into line 2A. So in this scenario, 494 goes into A, and 1,500 minus 494, let's say $1,006 goes into 2B right there. 2B is here. So 2B, $1,006, and 494 goes into there. Make sense? Questions? Okay, in regards to compensation for physical injuries and sickness, you might have a question from your client. The overall idea is this. If you have physical injury, it is excludable if compensation is for the injury, reimbursement for medical expenses related to the injury, right?
They talking about like the AFLAC plans, like the AFLAC plans.
AFLAC, I believe, is covering your income, right?
No, that's covered the issue, no?
I have no idea.
AFLAC, I believe it says if your hand is broken. That's what I saw in advertisement. Honestly, I don't have AFLAC myself, but it says if your hand is broken and you are not going to work, we will cover your.
But they have plans where, like, if you have an accident, you get this amount of money. If you go to the doctor, you get this amount of money. They have like accidental insurance, so.
But you pay Aflac with after tax, right?
Correct.
So in general, my answer is if you pay for something with after tax money as an extra insurance to cover yourself, anything you get from that, it's tax free. Because you paid from your money after tax, right? It's just like life insurance. If I pay, which I'm doing, I have life insurance. I pay with after tax. So if I die and I get $1 million, not me, but my family get $1 million, that $1 million is tax free. My family has $1 million solid. Make sense? Tax free. So that's the idea about it. So if you have a physical injury and you get compensation for that injury, it's tax free. But here says it's taxable, reimbursed medical expenses that were deducted in prior year.
What does that mean? What are they talking about?
That means, let's say you get medical expenses in year 2021, you put in itemized deduction and you use it for getting benefits out of that. And then next year, you got insurance or you sued someone to get that reimbursement.
Injury that was related to those medical expenses that you paid for the prior year.
Like a settlement.
Yeah, they said, wait a moment, you got $100,000 here in year 2022, but over there in year 21, you show, let's say, $80,000 of medical expenses in your itemized deduction, and you got this much benefit out of that, right? So you use that benefit, now you got reimbursed, so whatever you get reimbursed now, it's an
now
income.
taxable.
It's taxable now.
So in the following year, is that the one that you got now, is the following year, is that gonna be taxable?
If you don't itemize it the previous year, then it's yours, no problem. But if you itemize it, then it will be an issue. Because you cannot, IRS says you cannot double dip a benefit.
No.
You can use a benefit just once in one place, not two places. Same as the education expense that we were just talking about. However, sometimes you get a compensation as a punitive damage. That is giving hard time to that person, giving him a lesson to not do that bad thing again. If you get reimbursed for punitive damage, then it's fully taxable because you are trying to give him a lesson. Emotional injuries, normally emotional injuries resulted from physical injuries, it's not taxable. It is not taxable. But if emotional injuries are not technically that much related to your physical injuries, and it's a kind of punitive damage, then it's taxable. Payments for accidents or health insurance. Any payments that you receive from another taxpayer in excess of the actual expense, that obviously will be taxable. But if you get any payments for the accident to cover the medical expenses and damage to your car, obviously that is just recovering your situation that you are in, and that's not taxable.
What if can you deduct those expenses then though in your itemized deductions?
What expenses?
Well, you have medical expenses there.
Yes, medical
And then
expenses.
they're reimbursed, so isn't this another spot where it would be like, you probably put those medical expenses on your itemized deductions, and then you were, oh, I guess you shouldn't have if you were reimbursed for that.
If you are reimbursed, you should not put it in itemized deduction. But if you did it last year, and now you get reimbursed after 2-3 years down the road, now you have to show it as an income because you got the benefit out of it.
Okay.
Okay. Workers' compensation. Workers' compensation paid to injured employee to cover lost wages and pay the employee's medical expenses. That is an insurance that the employer is buying to prevent you to sue your employer. So your employer is paying for that. Taxpayers who receive workers' compensation exclude it from gross income, even though the payments are meant to replace the wages that they lost. Make sense? So whatever you get from your workers' compensation, God bless America. You don't pay taxes for it. Because your employer bought that insurance to cover himself from lawsuit. That's why employees, sometimes they don't like workers' compensation because it's expensive, but on the other side, it's a good thing because it's covering them. So employees cannot open a lawsuit, because if they can open a lawsuit, then it will be very bad situation for the business. They go bankrupt literally. So you should be happy to have a workers' comp, even though it's expensive. Compensatory payments awarded for non-physical injuries are always taxable. That's like punitive damage. Okay, but if it is for physical injury, then it is tax-free. Here, although emotional distress is not a physical injury, when payment for emotional distress are received as a result of physical injury or sickness, they are excluded from gross income because they are related to physical injury. Okay. Here he's talking about payments from an accident or health insurance plan. When injured persons receive payment from an accident or health insurance plan, we have accident plan also. Sometimes they just, insurance companies, they sell you accident plans. Whether those payments are excluded from gross income depends on who paid the premium and the relationship of the amount received to the actual medical expense. If insurance payments for medical care are excludable from the patient's gross income, if the patient or the employer paid the premium on the policy, depends how much. If the employee pays all of it, then it's everything tax-free. But if the employer pays a portion of it, that portion, that percentage, if you receive anything, will be taxable. And here is an example of 75% premium paid by employer. So if 75% is paid by employer and you get $1 million from that accident insurance, $1 million times 75%, that will be $750,000 of taxable income. But the other 25% will be tax-free because you paid for it. Fringe benefits are normally non-taxable because that comes from a package from your company, including health insurance, adoption assistance, athletic facilities. This is a package that it's a fringe benefit. The means benefit, educational assistance, employee discounts, group term life insurance, meals and lodging, military, certain expenses, non-additional cost services, retirement planning services, transportation benefits, tuition reduction, working condition. So those are things that might normally is not taxable.
I don't even know how you could monetize those because they're like that people give you. Like why no one would think to put the
One of the reasons that you cannot monetize them because this is offered to everyone in the company. IRS will get pissed off if it's just offering to high executives. In that case, it will make it taxable. But if it's offered to everyone, then it's not taxable.
I've worked on lots of jobs where things like meals and lodging are only provided to the upper level.
So they get taxed on that. Again, it's IRS. You are good as long as you don't get caught.
Exactly. Yeah, it's interesting.
And some companies will include that in their payroll.
Yeah, I'm sure some do,
Yeah.
but on the entertainment,
Yeah, they don't.
I do not think that they do. I mean, maybe super upper level, but when you're working on a movie or a TV show. And
That's why you are in strike right now, because of all those reasons. Yes.
True in a sense. I mean, generally everybody gets food, but I've definitely worked on certain things where only the above the line get food and everybody else.
Welcome to America.
And it's definitely not going on their W-2s.
Yes, we are learning all this stuff, but when you are at the top layer, it doesn't apply normally, right?
Yeah.
Yeah. Okay, we don't want to get political, but we have so many examples nowadays in news that you can see it's a political issue because those tax issues doesn't apply to you because you are at the top level with the presidential,
You mean the bonuses?
Level.
I mean, I just think about even like on a TV show, we pay for, if we bring an actor in from out of town, we just pay for their hotel room. We're not putting that, if they pay for it and you're paying them lodging, then it's on their W-2. But if you're just paying straight out for their lodging, then it's not gonna go on their W-2.
Okay. Sometimes depends why the company is paying for it. Is it for the company's benefit or is it for the employee's benefit? So that's it goes to the gray area, so you have to identify. Here is talking about key employees that I was mentioning. So in year 2022, key employee is an officer of company whose annual pay is above this level or an employee who owns at least 5% of the company. And so there are some criteria that you have to check those criteria to see if this is a key employee or not. And here says high paid employees are employees that, again, matching with one of those criteria. So fringe benefit may be excluded as long as it applies to everyone. But if it is discrimination issue and it is only applied to high key employees, then it will become taxable. Okay, so we covered this much. And let's look at this example. Company provides its employees with health insurance coverage during the year. It pays $8,000 to cover each of its employees as long as Santex plan does not favor or highly key or highly paid employees. None of the employees are taxed on that $8,000 insurance premium. However, if the plan discriminates in favor of these employees, the IRS could require that employer add the applicable amount to the taxable wages of its key employees only. As of early 2022, there is no such a requirement. If Santex provided medical reimbursement that are not offered through an insurance plan, it would need to add the reimbursement to the taxable wages of key employees. Okay, so adoption assistance as of 2022 is up to $14,890. and that is tax-free under an adoption assistance program by employer. So Joe's employer offers an adoption assistance program during 2022. So they have to do this to everyone, okay? During 2022, Joe is reimbursed $8,000 for adoption costs incurred during the year. Joe's AGI is 120. Since his AGI is less than 223,410 for the threshold, and the amount reimbursed is less than $14,000, the entire $8,000 is excludable from taxes. Again, this has to be offered to everyone, not just executives. Dependent care assistant is up to $8,000. And again, pays the, it has to be offered to everyone in the company. Let's look at an example so it's easier. Janet employers offer a dependent care FSA. This year, Janet contributes $5,000 of her $45,000 wages to her FSA. As Janet pays for the dependent care, she will submit her receipts to plan administrator for reimbursement from her account. The $5,000 Janet uses to fund her FSA excludes from gross income. This will be reflected on her W-2. So if you get the W-2, that's why I said put every dollar amount in every single box in the right place, because it will show, which will report $40,000 of taxable wages instead of $45,000 taxable wages. Because of her FSA contribution and reduced taxable wages, Janet will pay less taxes this year. Hence, Janet's total out-of-pocket costs for dependent care are actually less than $5,000 she paid to the child care provider. The minus.
So let me ask you, when you do have that flex plan, and say you get the money back, so you know, like in the programs when you put your dependent and the dependent care, doesn't that wash it out?
Yes.
Okay.
So if your employer gives you, let's say, $5,000, and then you spend $8,000 for dependent care, you have only $3,000 dependent care expense because you got already $5,000 from your employer. Now you put that $3,000 in the dependent care expense credit, and you get a percentage of that as a form of non-refundable credit, which we learned already. So de minimis is value, it's a small value, a small benefit. That's why they call it de minimis. Value that they receive from employees, like personal use of copy machines or office supplies, or a ticket to, Dodgers game, maybe something like that. Small holiday gift, turkeys, hams, those type of things. And if that is offered to, to anyone, because it's de minimis, is not taxable.
It's small, but it's like who has ever received a turkey from their boss and thought, I might need to put this on my tax?
Sometimes they don't receive turkey, but they receive a gift card from Raf's.
I would never even think of like, oh, I need to tell my tax account and I got a $50.
You're working in the wrong company.
But
that's the problem.
Companies will report it it'll be reported in their software.
Gosh, I feel so clueless, and I feel like if I'm clueless, then.
Remember, the $25 gift card that you receive and it's de minimis and you're not going to report it,
Right.
that $25 times 100 is
Yeah, so the
$2,500,
company wants. to
and
put
that's a
it-
company expense, fringe benefit expense. So the company is showing as an expense,
They're reporting it.
yeah, and they taking advantage of it. But IRS says, because you got $25, okay, forget it. You don't need to report that. But multiply that with 100 students, 100 employees, that's a big money, which company is using that as a form of tax, showing expenses. Educational assistance, again, if the company gives you educational assistance, each employee can exclude up to $5,250. Exclusions covers amount paid for tuition fees, books, and supplies, both graduates and undergraduate courses. Leon's employer offers an educational assistance program. During the year, Leon's was reimbursed $4,000 for tuition, books, and fees. Since this amount is less than $5,250 maximum exclusion, the $4,000 is excluded from Leon's gross income. However, don't think, oh, now I'm gonna put that $4,000 in American Opportunity and get another nice credit from there. You cannot double dip that. Employees discount, it's a little bit trickier. You might get employee discount on a service, or you might get an employee discount on a merchandise. If you get employee discount, and it has to be offered to everyone, okay, in the company. If you get up to 20% for services, the amount discount cannot exceed 20% of price charged to non-employee. And I'm highlighting this. For services is 20%, okay? For services is 20%. However, if it's for goods, like merchandise, it cannot exceed the employer's gross profit percentage times the price charged to non-employees. Gross profit percentage. So the gross profit percentage, normal for every company, it's an average. Let's say they sell a t-shirt for $25. Let's make it $100. They sell a t-shirt for $100, and the cost of t-shirt is $30. So revenue, $100 minus cost of goods sold, $30 gives you gross profit of $70. $70 divided by $100 sales revenue, that gives you 70% gross profit. Make sense? So the discount that you receive cannot exceed the gross profit percentage. Got it? Yes? Yes.
Question. I know in, let's say like the food industry, you get a free meal with like a shift, for example. So how would that work? Is that technically a good or a service?
That is free meal. It's part of, I think, you can call it de minimis, because everyone gets that free meal. It's not exclusive for executives, and it's not a big deal. That's tax-free. Yeah. And food, normally the company is showing cost of goods sold for the food value for material, right? So the company is deducting it anyway. If you don't eat that food, they might sell it. Worst come to worst, they throw it away. So it's not a big deal. But we are talking about merchandise, because let's say you are working in Home Depot and then you buy a drywall and you get 20% employee discount on that drywall. Drywall, let's say, is $100 and you get 20% employee discount, you only pay $80. So it's a merchandise. Now we have to see what's the gross profit ratio for Home Depot. If gross profit ratio for Home Depot is 70%, then your employee discount is not taxable because it's below that. and it is offered to everyone. That's why if you have, let's say, a cousin that works in Home Depot and you buy something, cousin says, come in this hour, I will scan my, my employee ID and you will get employee discount. The reason he's doing it because it's not taxable to him. If it was a taxable, he was not going to do that for you.
What about coupons for corporations? Like, or local coupons, like, can they write those off?
Coupons, again, normally they give you coupon below the gross profit ratio. They're not going to give you a coupon that is costing them money. They're giving you a coupon to give you a little bit of discount, keep you happy, but still make profit. As long as it's below gross profit ratio, those coupons are, in part of employee coupons, right? And they give to everyone.
Yeah, okay.
The whole thing is if they are giving to everyone. So there's example here. A clothing store offers a 15% discount to regular employees. It gives 25% discount to highly paid employees. Oops, right? The store gross profit percentage is 35%, which is sales minus gross cost of goods sold equals gross profit. Gross profit divided by sales gives you gross profit percentage. Although neither discount exceeds the 35% gross profit percentage, the difference in discount shows that the plan favors the highly paid employees. Therefore, the entire 25% discount on employees in favored group is added to the gross income for those favored groups. Regular employees are not affected. It's free for them, non-taxable. Make sense? Term life insurance is up to $50,000. Term life insurance is not taxable to me. So I get $50,000 term life insurance from Pasadena City College, right? Even though the company is paying for it, the organization is paying for it, but for me is tax-free, up to $50,000. Now, if they ask you, do you want more than? If I say, yes, I want more than 50, then I have to pay for it myself. If the company pays for it, then it will be a taxable calculation of that. So at PCC, they says, if you want more than 50, you have to pay for it. But there is a situation that the company says, I pay $100,000 life insurance for you. If the company pays $100,000 life insurance, the second $50,000 is a taxable amount. $1,000 multiplied with this cents, and depends how old are you. Your age, you go with the line, find the cents, 9 cents, times 1,000 times months. How many months? Here is a taxable amount. So monthly rate, which is here, multiply by number of 1,000 increments in excess of coverage. Let's say they offer me 75,000. The first 50 is free, but the second 25,000 is 25. Number of 25 times 1,000 is 25. So you put 25 here. Number of months of coverage, which is 12 months. So 12 months times 25 times the rate. So here's an example. Both company pays an annual premium for $94,700 of life insurance for Harry Socket, age 56. So $94,700 of life insurance for this employee. Pao shares the cost with Harry, who pays Pao $1,250 a month through payroll deductions. With these payments, Harry gets 12 months of group term life insurance protection. For Harry's age, the taxable figure 4.2 shows a monthly cost of 43 cents. He is how old? 56. So 56 is here, 43 cents right there. Bow adds $80.65 to taxable wages as computed below. Life insurance is $94,700. Up to $50,000 is exempt. So 94 minus 50 is 44. 44,000, the increment is 44.7. So cost subject to gross income inclusion is 44,700 divided by 1,000 is 44.7. 44.7 times 43 cents times 12 months, that's $230.65. However, Harry is paying $150 a year for that extra life insurance. Because he's paying $150 extra, but it's not enough, the remaining balance, it's going to become a taxable income.
I just don't, like, life insurance is only paid out if someone dies. Nobody's getting any money, they're just getting a policy.
Yes.
Why
So the company can, because company thinks to help your family just in case you die, company can offer you $50,000 life insurance and
Right.
pays the premium and put that premium as a business expense, employee benefit
Right.
expense,
I
right?
get that, so that's not,
So it's a good business expense on the one side. On the other side is giving you as an employee a peace of mind, just in case you die, you know your family will not be in big trouble right away. And so it's a win-win situation. But if it's offering more than $50,000, then it says it's going to be a taxable, and you have to calculate to see how much of that benefit it will be taxable, and you have to put it in your gross income. Excellent. But if let's say Harry says, I will pay $240 a year, which is $20 a month for this extra insurance, then because 240 is bigger than 230, then nothing will be taxable because Harry is paying for that extra $20 a month, which in my example, PCC, Pasadena City College, asked me, do you want extra insurance? If you want, you have to pay for it, whatever it is. I said, no, I don't want. And whatever it is, it's going to change every year. You know why? Because as I get older, that premium gets bigger and bigger and bigger. Make sense? But I said, no, I don't want it. The reason I don't want it is because I have my private debt, life insurance myself, so I don't need it. That $50,000 is more than welcome. Thank you so much. That's good. I like that. The rest comes from the life insurance. And having a life insurance, it's a very good idea, honestly, specifically if you make it whole life. I suggest to buy it as soon as possible. As long as you are younger, the premium will be much less, and it is going to go whole life, so your premium will not increase. But if you buy term life insurance, it's going to be increased significantly as you get older. So if you don't have that, think about it to get one ASAP. I give you an example. I bought whole life insurance for $100,000. It cost me $120 a month. I said, okay. Then a year later or 2 years later, I said, you know what? Let me increase it with another 100,000. I went back to the same guy, find the same exact 100 extra thousand. Now it became 150 a month for till end of my life. So now, because I bought it 2 years later, now I'm paying every month $30 extra for things that I could have bought 2 years before and end up being much cheaper. And the benefits, whatever I receive from that life insurance, my family receives that, it's tax-free. Okay, guys, we covered the life insurance, I believe. We're going to continue the rest of this next time. See you next time.